Real estate investment performance is made up largely of what you do to the real estate. That is, how you lease the buildings, what buildings you pick. But there is about 30 to 40% of performance is made up of when you buy a building, where, and what type of asset you buy. So we brought in the research group to help us with that aspect.
One of the things I'm most excited about was bringing Josh in to really lead the research. We were very cognizant that we wanted to do better to understand where we were in a market cycle. And when Josh came in, what we really asked him to do is think completely outside of the box. Think with a white sheet of paper. And what he really came up with is a view of pricing that we think has really become very predictive in the way that we see where we are in a cycle, in a market.
As I started to do R&D to come up with a model that informed us of where we were in the capital markets and fundamentals cycle, one of the goals was to take the economic forecast out of it. And I was somewhat skeptical that I would be able to get there, but it turns out using a pricing-based model incorporates the consensus economic forecast, and where prices are is much more important than where the economy is or where people think the economy is going.
There's a number of different forecasting approaches out there that use variables that we now know are not predictive at all. We identified 3 or 4 variables that work really well, they drive our models, and frankly, they don't drive anybody else's models. We think our framework is powerful and unique, and we apply that framework globally, so we have an objective, consistent view of, frankly, the whole world.
The factor that correlates best to future price growth is current pricing. To be able to buy an asset at a price that is below what we call long-term intrinsic value has a much higher probability of the asset appreciating over the following 5 years than to buy an asset at intrinsic value or above intrinsic value. Then there's an individual asset that the deal team uncovers. And so often those interactions are, is this deal indicative of the market, or is there something special about this deal where pricing is more attractive than the overall market? The access to local market information to me is unparalleled relative to other firms that I used to consult with. I employed analysts that attempted to have close to the market knowledge that the Hines local teams have. That is a huge competitive advantage because real estate's local, and that local information is vital to the critical execution of investment decisions.
Having a quantitative and back-tested framework that you trust can give you conviction and ideas that might seem contrarian. As an example, in the real estate boom market of 2006 and 2007, our models would have been saying sell, 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 but behaviorally, it's tough for investors in the moment to act on something like that, particularly when they look around the market and everything just feels so good. So in those types of situations, it's very powerful if you can point to an objective, proven model by back testing, by actual experience. We like to think that our research gives our Hines team members on the ground and our clients a competitive edge in a tough industry, putting us in the right assets, in the right markets at the right time.
Coming out of the Great Recession, after we created a research department, they were very strongly saying that now was a great time to be buying, and we did. We got fairly aggressive in what we were able to buy during that period, and since then prices have gone up by a good bit, so it really reinforced that research could be a huge addition to what we do as a firm.
If you want to produce top decile returns as an investor, you've got to do something different. And we think we are doing something different and focusing on price as the dominant factor of future price growth or losses.